All right. Well, I've been incredibly busy with work. Teach at the Otago Business School at the University of Otago. And so we've just been starting the second semester in our academical calendar year. And so I have had a crazy couple of weeks and have been overrun by students. I've been a little bit relaxed about getting some more videos out. However, when I'm looking for the dividend growth investing companies, I don't always go for deep value. Now, one of the companies that I do like here is Visa. And one of the benefits of Visa is this very powerful long-term increase here in the earnings. Now, these are the adjusted or operating earnings here shown in orange. Now, there was a dip here with the COVID. No real surprise there, but we've seen after COVID some strong growth. Now, I want to draw your attention particularly down here where we can see the annual growth rate of earnings here in the last several years, 17%, 27%, 17%, with estimates going forward of 13%, 12%, and 13%, 2026. Now you say, Lincoln, that sounds like a lot, and it is. But if we also look down here at the analyst scorecard, we can begin to see that there's a fairly good chance that the company's going to hit these earnings. We could also switch this over on FastGraph to the sales chart, and we would see again the same type of pattern with sales expected to increase 13, 10, and 10%. And again, an analyst scorecard here with 100% expectation that will hit more or less the 2-year projection from the analysts. I don't always buy, as I said, at fantastic value. Deep value, highly undervalued stocks is usually a reason that stock is undervalued. I do have a number of companies like Visa in my portfolio where I am very happy to add to them over time, gradually. Now, if we look at this over the last, since 2008, against this S&P 500, Visa would have paid more in dividends over that period of time. So total dividends reinvested would have exceeded that of the S&P 500. And we would have also seen greater performance growth in terms of share prices. Now, the Visa dividend growth we can see is often in the double digits over the last several years, which has been very powerful. Just particularly given that we have this very low starting dividend yield here of only 0.78%. So this is definitely not a short-term, near-term income play. This is, in my mind, a good long-term powerful compounder, compounding the earnings and therefore the value of the company, but also compounding with that rapid dividend growth of 10 to 20% per year most years. It is also going to be growing that very low dividend yield with time. So this is very much a company where I will be buying. I'll be buying this on reasonable dips here. So I think the last tranche I bought was about here in early 2023, and about the PE, I would think from memory it was around 25. So we're not far off that at the moment with a blended PE of about 20. I certainly wouldn't want to be paying a PE there of 32, represented here by the blue line. And that's what it has traded at over the last 5 years on average. But if we do hold to 32 and prices return to the 32 earnings multiple, and the analyst estimates here for 2026 accurate, then we could be looking at a total annualized rate of return of about 21%. Now that sounds to me optimistic. I would be very comfortable. I'd be very comfortable expecting it to remain at this 25 PE. And this would give me an annualized rate of return of about 10%. And that's a very small amount of dividends, but it's mostly benefiting from the change here in the earnings each year. And I think that's a relatively safe pick in terms of it's going to provide me with some good long-term earnings growth, as well as some good long-term dividend yield growth. Moving to greater income now, we have Hess Midstream. Now, even though it's got LP there, that is in fact a proper corporation, and so it's no longer a partnership, although it's still there in the name. Now, the dividend yield is quite attractive with the current dividend yield of 7%, and 2-year analyst estimates here. I think we need to treat these with a little bit of caution because of the very short history that the company has here. What I want to look at is I want to turn through to the forecasting, switch this to a normal multiple again. And so we've seen this normally has traded at about a 15 times price to earnings ratio, and pretty much bang on what it's traded at over the last 5 years at the moment. I want you to look here at the earnings. So earnings growth of 27% expected in 2024, 22% 2025, and 21% in 2026. Now we can see here over the last 6 months that the earnings growth has been relatively stable, perhaps growing a little bit. And so if we were to expect the company to have a price to earnings ratio of 15.18 times still at the end of 2026, and the analysts are correct about the earnings growth, we're going to be looking here then at this total annualized rate of return of about 28%. Now that's looking at the dividend per share, and I would also be expecting the dividends to increase, although not incredibly strongly. This is still, in my mind, going to be a nice increase. Now, the Hess Midstream, one of the beautiful things about the midstream companies is the relative stability in the earnings. And I think this is a very powerful option here if you're happy with the midstream companies and you're happy with a good dividend yield. It could add some nice diversification with some very powerful growth expected in the coming years. An alternative may be Enbridge. Now, Enbridge has some fabulous advantages. The dividend yield is more or less the same, but it also has a sterling history that we can see here that Hess Midstream does not have. Now, in terms of the forecasting, if we switch to using the normal multiple, so the 17.7 times multiple that Enbridge has exhibited over the last 5 years, we're going to see weaker growth than we would see with Hess Midstream. We can see growth of about 7% expected for 2025, and again, about 7% for 2026. And we can see that the analyst estimates over the last 6 months have been fairly steady or slightly improving with time. We can see that the dividends will increase, although not very strongly. And if we expect prices to return to the 17 times price to earnings ratio by the end of 2026, we might expect a 12% total annualized rate of return. I do think this is reasonable, and I do think the company is capable of achieving this. Now, when we look at the overall opportunity here, we can see it would beat the S&P 500 over the last 20 years. It would definitely rock the dividends here. Now, the dividend growth rate here, it's important to note this is in US dollars. And so the company itself has had a strong and consistent dividend growth rate in Canadian dollars, I believe. But the exchange rate can at times make it fluctuate and look a little bit odd here on the US listing for Enbridge. But we can see generally that it's had mid-single to double-digit dividend growth rate. Now, if we go to Enbridge and we look at the Canadian listing, the primary listing here, I believe the dividend growth rate has been positive the whole way through, as we can see here. And so we can see that the dividend growth rate has slowed down in recent years, has had many years of double-digit growth rate, but slowing down to about 3% in the more recent years. Now, okay, so if we think about that, we're still talking about a 7% dividend yield with slow growth rate there and some fairly stable and steady expectations here from the analysts. Now, switching gears slightly, this is the healthcare services industry. Now, this is Cigna Group. Now, it does have an A- credit rating, not too bad in terms of the long-term debt to capital ratio. But here I want to look at the analyst scorecard, and we can see that most of the time, 2 years out, they are hitting analyst expectations or beating analyst expectations. And that, my friends, is very exciting. Now, the dividend yield is 1.6, so you're not going to be living off this dividend anytime soon. In my mind, that's not the point. Let's take the price off this chart again, and we can see a bit of a dip here in 2016. But other than that, we can see this ongoing 36% growth, 20% growth, 8% growth. Remember, 14, 8, 14 estimated, 12 estimated, 12 estimated. So we can see here some good, powerful, long-term expected growth here in the earnings for Cigna. Now, if we begin to look then at the overall performance for the company, we can see again it's been one of the companies that has outperformed the S&P 500 over the last 20 years, with total dividends reinvested as more or less the same. Now, of course, the dividends have been sporadic. You can see some hazard, I would say, dividends over the early years here, and then a minuscule amount of dividends paid for many years before hitting the stride, I think. And what we're going to see is, I would say, low single digit, mid single digit, maybe high single digit dividend growth moving forward. So it's not going to be a dividend monster, but it is, I think, going to be a total return monster. Now, if you look at this, for example, yes, I love the analyst score, but I also like to see this. So it's traded over the last 5 years at a 12 times price to earnings multiple. It's a little bit higher than that now, but not horribly so. And if that continues, we would expect to see a total annualized rate of return of about 12% per annum. I like that for a nice long-term hold. Yes, you could have picked it up at a much better price here a year ago. If you're not able to buy it there, I think buying it at about this 12 times price to earnings is very reasonable. And we can also see over the last 6 months that the analyst estimates have been revised upwards slightly, showing I think a strong consistency here in expectations of how this company is going to perform over the next several years. Now, I do love my utilities, and I've recently started a position in WEC. Here is another opportunity in the US utility markets that I think is quite an appropriate selection. If we take price off the chart, again, we see the earnings have been increasing with this beautiful up and to the right earnings curve. We can see the dividend yield is 2.6%. And if we look at analyst scorecard, we can see once again a beautiful 100% hit on both 1 year and 2 year forward. Now, it is in the utilities market, and it does have reasonably high debt. It's about long-term debt to capital ratio of about 50%, but it does have the A- S&P credit rating, which I do like. Now, if we put price on the chart, well, we can see that it's been trading very much at a premium in recent years. If you were smart and snappy, you could have picked it up at an absolute bargain in late 2023. I had my money invested elsewhere, so I didn't get this opportunity. Is it the right pick for me now? To say. But if we do look at how it's performed over the last 20 years, it's run at about 15 per annum with a much healthier dividend and income yield than the S&P 500. And we can see here the dividend growth has been in the double digits just for the last several years as well. Or even if we look further back, it looks like mid to high single digits to low double digits, which is a nice dividend growth rate. If we do look at this in terms of the multiple that it has traded at over the last 5 years, I think that's excessive at 28 times on a price to earnings multiple, despite the benefits of the company. What might we expect? At the very least, I would expect here a 22 times price to earnings multiple. I think this is very safe. I think it could easily hit this. I think this is a very low bar here, a total annualized rate of return of 8.5%. Now, if the company does manage to hit the 28 times price to earnings multiple by the end of 2026, the total annualized rate of return might be as high as 18%, and it could very easily shoot up and over for that point, which could lead to some opportunity to take some capital gains. But is the company stable? If we look at the earnings estimates from the analysts over the last 6 months, they've been revised upwards, which is good to see. And we can see the analyst estimates here for the dividends are also growing, which is, again, something we want to see. The analyst estimates of the earnings growth rate of 7%, 8%, 7%. Yes, please. I think I would like a company growing at that rate with that beautiful historical growth rate that we looked at here. And we might expect it to continue to grow at these rates as well into the future. And so this might be a nice utility pick for you. If you want to take on a little bit more risk, here is National Grid from the UK. Now, this is an ADR, American Depository Receipt, and we can see here that it doesn't have that same beautiful earnings growth that we see with WEC or even the company that we just looked at, Extra Energy. It's much more sporadic, and this is more normal in many international markets. The credit rating isn't as good as we see with some of the other American utilities, but the long-term debt to capital, it's not bad. If we look at the normal multiple that it's traded at over the last 5 years, 17 times, that's reasonable, I think, in my mind. If we look at the estimates over the last 6 months, we can see that they've been strengthening and improving. And so if the company was to put this earnings estimate here by the end of 2027 or the 2027 financial year here, we might expect total annualized rates of return of about 16%. Now, the analyst scorecard is not as good as some of the other utilities, but the 2-year analyst scorecard is still 91 to 92%. So a reasonable track record here of the company hitting analyst expectations 2 years out. Now, on top of this, we have a nice dividend yield currently of about 5.6. And we can see the analyst estimates here for dividends. There are a decrease here in this financial year ending soon, but also some increases here into the future. Now, Broadcom is in the semiconductor industry. Yes, now this is an industry that has been on fire. S&P credit rating is weaker than some of the companies I've looked at BBB. The long-term debt to capital ratio is not too bad here. The analyst scorecard is looking fantastic though. 2 years out, they're hitting the earnings estimates 40% of the time, and the company's beating the analyst estimates more than half the time. So this is definitely a variance in the favor of the long-term investor, I think. Now again, from the dividend yield here, we're not talking about being able to live off these dividends, but at 1.4%, it doesn't look too bad. Now, if we switch over to the performance tab here on Fast Graphs, we can see a couple of key things. Number one, the compound annual growth rate has been astronomically higher than the S&P 500, and the total dividends reinvested since 2009 have also vastly exceeded the S&P 500. Now, we can see this is also partly driven here by a history of good dividend growth. Although 10 years ago, we were looking at, 40% dividend growth rates per year. In more recent years, we're looking at 10% dividend growth rates. And so I wouldn't expect it to, grow at 40% per year from 1.46%, but I think 10% per annum is a reasonable growth rate here. Now, let's put the price back on the chart, and we can see for a long time it was trading below this 30 times price to earnings line, and it's recently shot up with the AI boom and then recently shot down again. And what I want to do then is switch this over to the forecasting tool, look at the price to earnings multiple that it's traded at over the last 5 years. And this is where with fast graphs, I think you need to use this with a grain of salt. It has been on quite a tear in recent years. And we can see as well that the price to earnings multiple, even if we adjust it for the optimistic, it's traded at 16 times in the last year. The problem has been this sort of pop, this massive surge in prices that pushes it way higher very, very rapidly. So the question really comes, is this a good long-term hold? And if the company can continue to grow at, say, 17.75% per annum as their long-term growth rate over the next 5 years, I think this is a reasonable hold here, although I do think this is overvalued, and I personally believe that semiconductors are a little bit frothy at the moment, and I'm not buying it at this level, but it could be a very long-term hold where you might expect a reasonable rate of return, although I think we're going to see prices zig and zag and zig and sag perhaps over the interim period. So for me, this is probably a pass, but if I had to pick a semiconductor stock at the moment, it would probably be Broadcom. Looking through the financials here, BNS, Bank of Nova Scotia, this is the US listing, and we're looking at a nearly 7% dividend yield. We can see here the analyst scorecard, as with many financials, isn't as great as it is with other stocks, but it is an A+ S&P credit rated with a reasonable low long-term debt to capital ratio here of about 13%. As we begin to look at the performance for time, we can see that it's lagged the S&P 500, although in terms of the dividend reinvestment, it has powerfully outperformed the S&P 500. Now, again, it's a Canadian listed company, so these dividend growth rates is also reflecting Canadian to US exchange rates. But we can see here, I think we can look at a mid-single digit dividend growth rate for most years in the US holdings here, on top from the 6.8%. So even if you're considering this at 6.8%, the dividend growth rate at about 5% per year, I think this is reasonably comfortable. Now, the forecasting here is at the normal multiple here of about 9.6 times, which I think is reasonable. We might be looking at about a 14% to 15% total annualized rate of return. Now, where is this coming from? Well, we can see that the analyst estimates have been decreasing over the last 6 months. So it's a slightly weaker pick for me, but it does have the nice current dividend yield with some good dividend growth rates expected, or a moderate dividend growth rate expected. Could be a stock that would be hammered if there is a recession coming. So for me, this would be very much a stock pick that I would be looking at for a very small portion of the portfolio, and I'll be holding it cautiously as well because of the likelihood of poor performance during economically tumultuous times. Here from investment banking and brokerage in the US, A- this time, slightly higher debt capital ratio. And on the scorecard here is beating 33% of the time and hitting nearly 60% of the time. So pretty good looking 2-year forward. Comes in at 1.5% dividend yield, and it's Raymond James Financial. Now, if we look at this chart here, it's not the most perfect chart, but if we ignore this COVID gap dip, they've been growing, and since about 2015, the growth rate seems to have stabilized at about high single digits to low double digit growth rates, which is good. And if we look at the long-term financial performance here, we can see that it exceeds the S&P 500. And the last, with the dividend growth rates, total dividends reinvested as well. The dividend growth rate has been sporadic. It's been from mid-single digits 12 years ago through to incredibly powerful double digits, through to some very nice double-digit growth rate for the dividends as well. But I think if we look at the forecasting, this is where this pick could again show a reasonable value at the moment. We can see that over the last 6 months, analysts have more or less maintained their estimates of the earnings. And we can see that it's a 15% growth rate for this year, then a 5%, then an 8% in the coming years, giving us a reasonable total annualized rate of return of 9%, including the 1.5% dividend yield. Is this on my radar? Yes. Is it one that I'm buying now? No. I think if I was waiting for it to come down into the sort of the 11 times PE or 10 times PE zone, I think that would make a more compelling buy given the current set of circumstances that I'm looking at. Now, in the REIT world as well, one of the companies that I continue to like is Agree Realty Corp. Now, in my mind, this is similar to the Realty Income, but they are smaller. And I think they have more opportunity to grow a quality portfolio at a better rate than a huge company. Now, the analyst scorecard is good for 2 years out. We actually look at the scorecard and we look at the misses here for the 2 years. We can see that it looks good for the last 10 periods. And so when we're thinking about those misses, it is a long time ago. And I think they've been doing a really good job of growing the adjusted funds from operations, which is like the REIT version of earnings. There was a challenge here coming out of the global financial crisis into about 2010. Since about 2012, the last 12 years, they've been growing this at a really steady single-digit rate, which is good. And that's the type of company that I like to see, with good, slow, steady performance. Now, it's got a triple B plus credit rating S&P 500. I think the reason it can't quite crack the A minus is possibly because of the market cap being quite low still. So it's a relatively small REIT. The overall performance, I think, has been good. So if you're looking here compared to the S&P 500, very comparable performance since 2007, but a very powerful change here when you look at the total dividends reinvested by about $20,000 over that period compared to 6.5 in the S&P 500. The dividend growth rate, it's not stellar. But if we look down here since about 2013, I think this would average out somewhere about a 5% dividend growth rate per year, which is not to be sneezed at. So when we look at what's going on here, I'm going to switch to the normal multiple that it's had over the last 5 years. Now we can see this recent spike here in prices, making it less attractive now. And we can look down here and see analyst estimates for the adjusted funds from operation. They've been relatively steady, improving slightly over the last 6 months as analysts have improved their estimates of the AFFO. And from this then, if we look at the returns expected, if prices can return to this multiple and the analysts have this estimate correct for the end of 2024, then we could be looking at about 13% total annualized rate of return, which incorporates both, again, the dividends as well as this single-digit growth rate here in the AFF. So is this great value now? No. Is this one that I'd be happy to add to? Yes, I do add to Agree Realty on a regular basis, but it's not something that I am buying now as much as I was buying early here in 2024 when the price to earnings ratio was lower at about 14 times, representing, in my mind, a much better entry point than now. Now, it's good. It's fine if I had to increase my exposure to triple net lease REITs. This is probably where I would be putting some more funding today. And let me know what you think. I mean, this is not any heavy value here. I tried to pick a range of companies which have reasonable value, a range of companies which have some good growth rates moving forward. And again, these companies are companies that I think you could buy and hold for multiple years with a range of different options here in terms of the sub-industries and industries and type of companies as well that you could get exposure to really diversify a long-term dividend growth investment portfolio. Let me know which of these you like down in the comments below, and let me know if you think I got the opportunity here to add some really deep value stocks. You know what they are. Please do share with me and share with everyone else in the comments, and I will get back to you very soon.